Hi, I'm Kara Murphy, and this is Money with Murphy. With the election behind us, let's talk about tariffs. It's important to know that tariffs aren't new. They've been a tool in U.S. policy for centuries, often used to protect key industries that are considered crucial to national interests. The idea is to make imported products more expensive and encourage businesses to produce those products at home instead. While tariffs may not be new, they have not been used very actively since the 1930s. Then in 2015, tariffs became a focal point of Donald Trump's first presidential race. In fact, his views on tariffs are documented in interviews dating back to the 80s. A big part of Trump's platform was using tariffs to strengthen American industry and reduce reliance on foreign goods, particularly Chinese goods. But here's something you may not know. Even after Trump left office, the tariffs he put in place largely stuck around. In fact, Democrats didn't just keep many of these tariffs, they expanded them, signaling that tariffs, to some degree, have started to gain bipartisan support. So let's break down some of Trump's notable tariffs during his first term, or what we'll call Trump Tariffs 1.0. That program saw targeted measures, like a 30% tariff on solar panels that gradually decreased over 4 years, and a similar structure for imported washing machines. Steel imports got hit with a 25% tariff, and aluminum with a 10% tariff. The idea here was pretty straightforward: protect specific American industries. Now, in terms of the inflationary impact, the Peterson Institute estimates that these tariffs added about 0.25 percentage point to the consumer price index. But did these tariffs change the trade landscape? To some extent, yes. The U.S. trade deficit with China did decrease after the tariffs were put into effect. At the same time, though, U.S. trade deficit with other countries increased. In other words, instead of buying U.S.-made goods, American consumers and businesses simply shifted their buying to non-Chinese goods. So what about Trump Tariffs 2.0? He's proposed a blanket 10% tariff on all imports, plus a 60% on Chinese goods, and for cars manufactured in Mexico with Chinese parts, a 100% tariff. Trump's plan would also involve renegotiating or withdrawing from existing trade deals. Unlike tax policy that must be approved by Congress, most of these tariff proposals can be enacted unilaterally and quickly. So what does this mean? It's a little bit tricky to answer. First, it's important to note that Tariffs 2.0 is expected to be much larger than the previous round. As proposed, the tariffs could bring in upwards of $300 billion a year. Now, with the U.S. fiscal deficit approaching $2 trillion, that could be a welcome source of income for a cash-strapped government. Second, tariffs, especially of this size, would likely change the behavior of consumers, businesses, and other countries. For instance, if all imported goods are more expensive, consumers may simply buy fewer goods. Businesses may try to find cheaper inputs that are made here in the U.S., or they may choose some combination of increasing prices or accepting lower profits. Our trading partners are unlikely to accept tariffs without some sort of retaliatory measures. If you hike your tariffs, I'll hike mine. As a result, U.S. manufacturers may have a harder time selling their wares overseas. Finally, while it's difficult to predict exactly how behavior may change, tariffs, if implemented as Trump has suggested, are likely to increase inflation, though here too estimates vary widely, from 0.5 percentage point to as much as 1.5%, depending on how these tariffs are rolled out. In turn, higher inflation can make the Federal Reserve less willing to lower interest rates. So while tariffs might seem like a distant policy that only affects businesses, they have a way of showing up in the price of your next appliance or the cost of a new car. And while tariffs are relatively easy for a U.S. president to install, they're also relatively easy to dismantle, should the economic effects be deemed too negative. Importantly, a diversified portfolio benefits from companies less exposed to tariffs and mitigates the impact that tariffs may have on companies that are more exposed. As always, we'll keep an eye on how these policies evolve so you know what to expect next. And until next time, invest wisely and live richly.